So today we're going to continue our discussion with saving and investing. So first thing I want to talk about here is your role as a saver and investor. So the first thing you want to do is you want to think about the safety of your money. You want to make sure that your money's safe. We talked about the FDIC and your money is pretty safe and against the um, anything happening to it. The second thing you want to do is you want to figure out a good rate of return. You want to find out what ways that your money can grow itself as it is in this whatever saving avenue you have or vehicle you have. So you want a good rate of return. The stock market risk gives you a great rate of return. Okay, usually 13% on average is what the stock market returns per year, but it is a risk. You can lose all your money in that stock market. If you had invested in one stock and it goes down a lot, you can lose all your money. That's why I wanted you to diversify your stock portfolio in the stock market game. Okay, compound interest. This is paid on both the principal and interest already earned. Okay, so basically it's a bad thing when we're talking about credit cards, how that compound interest is going to continually uh, accrue and grow as your credit card is sitting there. So it's bad, and you have a lot of credit card debt. Well, compound interest is wonderful in investing. When you have a chance to put your money in, and that compound interest can help it grow over the years, you can, in the long run, make a lot of money. And diversification, I talked about that already a little bit. Spreading of investment among several different types to lower your overall risk. So again, in the stock market, you want to have some in technology and have some in basic materials and have some in the everyday, Coca-Cola and so on and so forth. Energy, technology again, maybe oil, so on and so forth. Okay. So the rule of 72, this talks about the number of years required to double your money at a given annual rate of return. So a rule states you divide the rate, expressed as a percentage, into 72. So basically, if I was getting 8% on my rate of return, 72 divided by 8 would be 9 years. It would take 9 years compound annual interest to double my investment. If I was getting 3% on this, it's going to take me 24 years to double. Okay, so again, trying to invest early. You want to invest early so that years can help you grow in that compound interest. So again, if I gave you a penny right now or $10,000, if I give you a penny right where that first penny's at, and by the X over there, what would you take? A penny, growing until it gets to the X, or $10,000 right now? I'm sure most of you probably figure out now you want to take the penny because it's going to grow with that compound interest. And you can see, not much yet, but over the years, it ends up growing to be bigger than the $10,000 I originally would give you. All right, so stocks, we did this last week. We're invested in some stocks. Want to make sure we touch base on this again. So stockholders, these are owners of stock. Dividends, this is a return a stockholder received on the amount he or she invested in the company. So this might be a quarterly thing, excuse me, might be an annual or biannual return on your investment. Capital gains, this is an increase in the value of an asset from the time it was bought to the time it was sold. Okay, you have to pay taxes on these capital gains. So for example, if you buy a house at one price and then 6 months, 8 months later you decide to sell it, maybe in real estate, maybe you flip your house or something, you sell it and you gain $10,000 on it, that's a capital gains and you have to pay that tax. Capital loss then is a decrease in value of an asset from the time it was bought to the time it was sold. All right, so a broker, this is a person who acts as a go-between for buyers and sellers of stocks and bonds. And you might not have them as much anymore because you have a lot of the online selling and buying of stocks. But you still have some brokers out there that will buy the stocks and bonds for you. So that a bond is a certificate issued by a company or the government in exchange for borrowed funds. A savings bond is purchased at half the face value and increases every 6 months until the full face value is reached. So here's an example of a savings bond, $100 Series EE savings bond. And maybe some of you have these. I know my grandparents used to get these for us for every Christmas. So $100, for example, they'd pay $50 for the $100 bond. And so you think you have $100, right? Well, no, you really don't. If you go cash these, first of all, you should wait till it's mature. So in the top right-hand corner, you see that it says 12/2001. That's when the bond is matured. That's when you'll get the most money out of the bond. So if you go cash it, and let's say in December of 2001, and you go cash it at the bank, you'll probably get about $72, $73 back, maybe a little bit more. And then that other $20 or what's left would be taxable. Okay, so you would then get taxed on that income that year. So because you're getting money into yourself, you are going to be taxed on that. And if you go cash this before it's mature, you might get $55 to $57, okay, because it's not mature. So you kind of want to wait till these savings bonds actually hit maturity. Treasury bills, notes, and bonds. These are issued by the U.S. Treasury in exchange for a minimum of $1,000 and mature in a few days up to 26 weeks. That's the first one, the Treasury bill. Okay, so all three of these are issued by the U.S. government, U.S. Treasury, and you have to have a minimum of $1,000. The difference between all these is they're maturing. So you notice the maturing date for the Treasury bill is a few days or up to 26 weeks, half a year. A Treasury note matures in 2 to 10 years, and a Treasury bond doesn't mature for 30 years. So again, they're all done by the U.S. government. You have to have a minimum of $1,000 in each, and you just, the maturity dates are the difference of each one. Stock exchanges I want to talk about. I touched base on these when we did the stocks online. But the New York Stock Exchange, otherwise known as the NYSE, you see that most notably, the NYSE. Over-the-counter market is called NASDAQ, the National Associate of Securities Dealers Automated Quotations. Just know NASDAQ. That's a big thing you need to know there. These are electronic companies mostly, and also smaller companies. So these are where your stocks are going to be traded, on these markets, on these exchanges. The New York Stock Exchange, NASDAQ, and we'll talk about the S&P 500 as well. The Dow Jones Industrial Average, probably something you've heard about before, I hope. It's the most well-known stock market index. So this is basically, it's often called the Dow. And this is basically telling us how the stock market is doing. So it takes 30 major companies in the United States, and it looks at all those different companies, and then it goes up or down based on those 30 major companies. So it's pretty much well known, the Dow is. One that is probably getting a little bit more attention later is called the Standard & Poor's 500, or S&P 500. And it gets a little bit more notoriety now because it's 500 companies tracked. So it maybe does a better job of tracking the true stock market because it's tracking 500 different ones and not 30. I'll show you those in a little bit here when I get out of this. A bull market, if you heard of these with the stock market, a bull market is a period of time when stock prices move up steadily, investors start buying. Whereas a bear market is when stock prices have been dropping for a period of time and investors sell their stocks. Again, the way I like to think of these, maybe bear is going into hibernation for the winter. Therefore, they're not going to be doing much, so you start selling your stock. Maybe a bull, I think of their horns charging up and at somebody. They're rising up at you. Maybe a good way of differentiating between the two. A mutual fund, then, a little different than a stock. This is an investment company that pools the funds of many individuals to buy stocks, bonds, or other investments. So I know that one of them is called an American fund, is a mutual fund. So they're going to buy stocks, bonds, other investments with a whole bunch of our money, all of us together maybe. A money market fund. This is a type of mutual fund that uses investors' funds to make short-term loans to businesses and banks. And then government regulations on this. It's called the SEC. No, that's not the football powerhouse that Alabama, plays in conference. The SEC is called the Securities and Exchange Commission. It was created in 1934 along with the New Deal with FDR, and it administers all federal security laws. So they basically govern and regulate the stock market and these federal securities. The SEC is what it's called. So now what I want to do is I want to show you the Dow and the S&P 500 on Yahoo Finance. So again, you go to Yahoo Finance here, and right here you can see there's the Dow 30. Notice it's down today, $62.90. Okay, here's the S&P 500. Notice it's down $15 right there. Okay, and then there's NASDAQ right there. So again, if you click on the Dow 30, we can kind of see what companies maybe are in there. Maybe. And again, these are 30 companies on the New York Stock Exchange. So again, if people say the Dow, they're referring to this, Dow Jones Industrial Average. That's what they're referring to when they say the Dow is down 57 points. And you notice that it's been down, quite a bit today, without a doubt. And if you take a look at it in the past 6 months, look at the last 6 months of the Dow, you can see it's been steadily rising pretty good. So that's a little bit more about stock markets and the Dow and the S&P 500.